Imagine a company whose stock right now is trading for just over $4. But some analysts, and actually even our own models, suggest its true value could easily be double, maybe even triple that.
Mhm.
It's the ultimate high-stakes gamble, really. Massive potential upside if their, well, ambitious plan actually unfolds, but also a very real chance of significant downside if the execution falters.
Definitely a story worth watching.
So today we're taking a deep dive into that exact story. Welcome to the deep dive, where we take your sources and pull out the most important insights, all custom tailored for you.
Our mission today is to unpack the investment case for PowerFleet Inc. They trade on the NASDAQ under the ticker AIoT, that's AIoT, for artificial intelligence of things.
Yep. And we're looking at all the pivotal moments, what they mean for the company's future. Our analysis is based on info available as of July 16th, 2025, and we're using a reference share price of 4.165 cents.
What's particularly, compelling about PowerFleet's journey is just how quickly they've fundamentally reshaped their scale, their strategy, their whole market position, really,
Yeah.
through some very aggressive acquisition.
Right.
So the core question for us, I think, is whether they can actually pull off the integration of these, vastly expanded global operations, find sustained profitability, and truly emerge as a dominant data-powered AIoT leader in what's still a pretty fragmented market.
Okay, let's jump straight into chapter 1. Business analysis. Forging a global leader in a fragmented market. We really need to start by understanding their core business.
Mhm.
PowerFleet operates on, well, you could call it a hybrid model, but they've been very deliberate, very focused on shifting towards a subscription-first approach.
Yeah, that's key.
Their software as a service, or SaaS platform, is now generating that high-margin recurring revenue. And it accounts for, get this, about 75% of their total revenue,
Wow.
which is a huge leap from just 37% before this recent acquisition spree.
And that strategic pivot, moving to subscription first, it's incredibly significant. It fundamentally improves the predictability of their earnings, right? That's something investors deeply value.
Absolutely.
It signals a clear intent to move towards a much more attractive business profile. It's not just about the top-line revenue. It's really about the quality and the stickiness of that revenue stream.
And at the very heart of this whole transformation is their Unity platform.
Right.
This thing is, well, it's device agnostic, cloud-based, and artificial intelligence of things platform. It's genuinely designed to be a sort of data superpower.
So it can pull data from anywhere.
Exactly. It can ingest data from any source, PowerFleet's own hardware, third-party stuff, embedded OEM systems, and it brings it all together into a single pane of glass for the customer.
Okay.
Their stated goal is pretty simple: helping customers save lives, time, and money using AI-driven insights.
Makes sense.
So what kind of solutions does this platform actually power? Well, their offerings are organized into key suites. First, you've got fleet management solutions. That includes vehicle telematics, dash cams, and a really innovative recent addition, the automated AI risk intervention module.
Interesting.
Yeah, it leverages AI to proactively spot risky driving behaviors. Then, they also tackle the warehouse sector with material handling telematics.
Okay.
And finally, in asset tracking, they're actually recognized by ABI Research as the #1 global commercial cold chain solution provider.
That's quite an accolade.
It is. And they market all these solutions under well-known acquired brands like PowerFleet itself, Pointer, Celicator, Mixed by PowerFleet, and Fleet Complete.
That Unity platform really is key then. You might ask, well, what's their core value proposition in what's obviously a crowded space?
Good question.
Well, the modern logistics industry, it often grapples with mixed fleets, right? Data silos from all different manufacturers.
Yeah.
PowerFleet aims to solve this directly by being OEM agnostic.
Yeah.
The Unity platform basically consolidates data from all these diverse sources, allowing customers to manage their entire, often very heterogeneous, fleet from one single centralized dashboard.
Yeah.
They even claim customers typically see a full return on their investment within about 12 months.
That's a strong claim. And this aggressive M&A strategy has just profoundly reshaped their market position and scale.
You can really see it in the numbers.
Yeah, the acquisitions of Mixed Telematics and Fleet Complete have quadrupled their subscriber base to an astounding 2.8 million units. That positions them among the top 3 global AIoT SaaS providers.
Top 3 globally, that's significant scale.
It really is. They now boast a truly global footprint. serving 48,000 customers across 120 countries. And that includes blue-chip names you definitely recognize like Walmart, Toyota, Avis.
Hmm.
And impressively, no single customer accounts for more than 10% of revenue, which is great for diversification, reduces that customer concentration risk.
Always good to see.
Now, let's turn to the industry analysis. They operate in the global commercial vehicle telematics market. And this market isn't just large, it's rapidly expanding.
Yeah, the growth numbers are pretty eye-popping.
We're talking projections of somewhere between 8.9% to 16% compound annual growth rate, CAGR, through the next decade. It could potentially exceed $170 billion by the early 2030s.
Wow. So what's driving all that growth?
Well, it's a few things. Demand for operational efficiency, regulatory mandates like ELDs, that's electronic logging devices, and hours of service rules, which track driver times for safety.
Right. Compliance is a big driver.
Definitely. Plus technological advancements like 5G and AI, and of course, the big ongoing transition towards electric and autonomous vehicles.
What's particularly interesting, I think, is the dynamic at play with inflation.
How so?
Well, while rising costs certainly impact PowerFleet's own expenses, it simultaneously seems to amplify the urgency for their customers to adopt cost-saving technologies.
Oh.
Studies actually suggest that both consumer and commercial interest in telematics surges during periods of high inflation, especially when companies are looking hard for ways to lower things like insurance premiums.
So economic headwinds for the broader economy can paradoxically act as a demand catalyst for them.
Exactly. It's a powerful potential tailwind, counterintuitive as it might seem.
Okay. Now, the competitive landscape. It's both fierce and fragmented, wouldn't you say?
Absolutely. You've got pure-play telematics providers, think Samsara, Geotab, Verizon Connect. But you also have the large OEMs, the original equipment manufacturers, truck makers, car makers.
Right, embedding their own solutions directly into vehicles.
Yeah. And PowerFleet's Unity platform is strategically designed to counter that OEM threat by integrating data from those very systems.
Makes sense. And the barriers to entry in this space are pretty significant. You need high initial investment, serious technological sophistication, and increasingly, data acts as a powerful moat.
Mm-hmm.
PowerFleet's existing 2.8 million subscriber data gives them a formidable advantage for training their AI models.
Given this landscape, it's worth asking, where does their true competitive advantage lie? Morningstar, for instance, assigns them none for an economic moat, which is a pretty strong statement.
It is.
However, their post-acquisition scale now creates significant economies of scale. They can spread R&D and operating costs over a much larger base.
Yeah.
That's a powerful leverage point in itself.
But I think maybe their most durable advantage might actually be switching costs.
Explain that a bit more.
Well, once a client integrates their entire diverse fleet onto the Unity platform and then connects that platform into their core business systems, think payroll, logistics, maintenance record.
Integration.
Exactly. Migrating away from that becomes prohibitively expensive and complex. The more systems they connect, the stickier PowerFleet gets, essentially locking customers in.
Yeah, that makes sense. And beyond just the switching costs, you have their unique assets, right? Like those 37 U.S. patents, device-agnostic Unity platform itself, and the advanced AI analytics, like that AI risk intervention module you mentioned. These really fortify their position. Their acquisition strategy, it's clearly not just about grabbing market share. It's a direct enabler of the Unity platform, rapidly populating it with data from millions of new subscriber units, which in turn fuels and enhances their AI capabilities. It's a virtuous cycle, potentially.
Okay, let's shift our focus now. Let's talk Chapter 2, Management Evaluation, a leadership team built for acquisition and growth.
Right, the people driving the ship.
The current strategic direction is largely spearheaded by CEO Steve Towe. He was appointed back in January 2022. He's a seasoned executive, over 16 years experience in SaaS and IoT, particularly known for scaling tech companies and executing complex M&A.
He's got the track record then.
Seems so. He was previously CCO at Masternaut and MD of the highly acquisitive Cibit, and his team, including CFO David Wilson and Chief Corporate Development Officer Melissa Ingram, they also bring extensive M&A and finance backgrounds to the table.
And one might ask, how has this leadership team performed under what's clearly been immense pressure?
Good point.
I mean, this team has navigated supply chain disruptions, geopolitical instability impacting their R&D operations in Israel, and even a complex financial restatement.
Right.
All while executing two major global acquisitions pretty much simultaneously. Their ability to manage those concurrent pressures is, well, it's really defining for their tenure so far.
Their communication seems clear, consistent. They're articulating the strategic vision to build a global AIoT SaaS leader centered on that Unity platform.
Transparency matters too?
Yep, they provide transparent metrics like subscriber growth, recurring revenue percentage. And they seem to maintain a strong ethical reputation, no major controversies popping up. The Fleet Complete acquisition even brought a formal global business integrity policy with it.
Okay.
And now let's talk capital allocation. It seems it's all about transformation through M&A.
And that's exactly right. What's crystal clear about their capital allocation priorities is that they are firmly, almost exclusively focused on growth and integration right now. They don't pay dividends. There's no evidence of share buybacks. In fact, they've actively issued shares to finance these acquisitions. They've been very aggressive on this M&A front.
Just to give you a sense of the recent history, Fleet Complete, $200 million, October 2024, added 600,000 subscribers. Then the merger with Mixed Telematics, April 2024, brought in another 1.1 million subscribers.
Huge additions.
And prior to that, Pointer Telecation, $140 million in October 2019, and Keytroller way back in 2017. Beyond M&A, they also invest heavily in R&D, specifically for Unity and their AI capabilities.
Right.
Currently, their return on invested capital, ROIC, it's negative, somewhere between -6.21% and -7.43%.
Which isn't unexpected, really.
No, it's largely expected for a company that just deployed massive amounts of capital on acquisitions. The real test for management's prowess, the real proof, will be their future ability to generate returns well in excess of their cost of capital from this newly expanded asset base.
And a critical question always surrounds management incentives. How are they aligned?
Good question.
When we look at CEO Steve Toe's compensation package, it includes significant equity awards. But the strike prices are set at $10.50, $14, and even $21 per share.
Wow, much higher than current levels.
Substantially higher.
Yeah.
It means his compensation is essentially worthless unless he drives a 2.5x to 5x increase in shareholder value from where things stand now. That creates a very strong alignment between his interests and achieving that long-term strategic success.
Okay, next up, let's dive into Chapter 3, Financial Analysis. The financial picture of a company in transformation.
Right, let's crunch some numbers.
As of July 16th, 2025, PowerFleet's market cap stands around $555 million. Their revenue growth, as we've said, has been explosive directly because of these acquisitions. For the fiscal year ending March 31st, 2025, total revenue was $362.5 million. That's a 25% year-over-year increase.
Solid growth.
And the pro forma combined company, looking forward, is projected to have an annual revenue run rate over $400 million. Management is guiding for a pretty robust 20-25% total revenue growth for fiscal year 2026.
Okay, what about profit margins? Because revenue growth is one thing.
Good point.
Profitability is another. It's worth noting the blended gross margin for the most recent fiscal year was 53.7%. However, the high-value service revenue portion, the SaaS part, carries a much healthier 68.8% gross margin.
Much better.
While the hardware is much thinner, down at 28.7%. So that strategic shift we talked about, getting to 75% SaaS revenue, that's a powerful positive. It really sets the stage for significant future blended gross margin expansion. That's where the real operating leverage is.
Makes sense. Now, on a GAAP basis, that standard generally accepted accounting principles they're operating, and net margins are currently negative. That's primarily due to significant, often non-cash M&A integration expenses. Normal noise after big deals.
Right. Restructuring costs, amortization.
Exactly. However, adjusted EBITDA, which backs out some of those items, does show progress. In fiscal year 2025, it climbed a remarkable 65% to $71 million.
That's a big jump.
And the margin expanded to 20%, which clearly highlights that synergy realization is starting to happen.
Okay, that's a positive sign. What about cash flow?
Historically, free cash flow has been inconsistent and largely negative. The company has been in a heavy investment phase.
Makes sense.
So a core part of the bull case, the optimistic view for investors, hinges entirely on management's ability to pivot this newly scaled enterprise into a consistent free cash flow generator. That's the goal.
And what about financial stability? You mentioned debt earlier.
Yeah. So while GAAP earnings show that history of consistent net losses, their debt-to-equity ratio is, well, moderate. It ranges between 0.39 and 0.64.
Okay.
However, they did take on substantial new borrowings to finance those acquisitions. Net debt is now around $230 million.
Relative to a market cap of about $555 billion.
Yeah.
So significant leverage.
Yes. Managing this debt is definitely a key priority. Their current ratio, which measures short-term liquidity, is adequate at 1.12.
Okay.
Moving to valuation. Their current lack of GAAP profitability means the traditional price-to-earnings, or PE ratio, isn't really meaningful here. Doesn't tell you much.
Right, need other metrics.
So other relative metrics are more appropriate. Their price-to-sales, PS, is approximately 1.53x. That's relatively low for a SaaS-oriented company, wouldn't you say?
Yeah, definitely reflects market caution. It's pricing in that execution risk we keep talking about.
Exactly. And price to book, PB, is around 1.26x.
So considering intrinsic value, what's it really worth? A discounted cash flow, a DCF analysis, seems pretty well suited for a company like PowerFleet, right? Where current earnings just don't reflect the future potential.
Agreed.
So based on our educational DCF model assumptions, and these are just assumptions, mind you, things like 20% revenue growth tapering down to 10% over 5 years, adjusted EBITDA margins expanding from the current 20% up towards maybe 28% as synergies are realized,
Okay.
using a discount rate of 9.0% to 11.0% and a terminal growth rate of 2.5%. Well, this model generates an estimated intrinsic value range of $7.50 to $11 per share.
Okay, $7.50 to $11. That's quite a bit higher than the current 4.165 cents.
It is significant potential upside if those assumptions play out.
Right. Okay, let's shift gears and dive into Chapter 4, Market Sentiment. How is the market actually viewing this stock?
Well, it's a real mixed bag.
On the one hand, Wall Street sentiment is decidedly bullish. The consensus rating among analysts covering the stock is a strong buy or buy. There are no hold or sell ratings currently.
That's quite positive.
Yeah, and the average 12-month price target is around $10.14 to $10.50. That implies, over 140% potential upside from the current share price.
Wow.
Though the forecast range is pretty wide, from about $7 up to almost $16. Recent news flow has also been positive, highlighting operational developments, framing earnings as part of a potential breakout year.
Okay, so analysts are optimistic. But what's fascinating here, despite all this positive analyst talk and news flow, is this significant undercurrent of bearish sentiment.
How do we see that?
Short interest. It's notably high. We're talking 14.33 million shares held short. That represents about 10.75% of the outstanding shares and 11.60% of the public float.
That's a pretty big bet against the company.
It is. And the days to cover ratio is approximately 5.85. That indicates a considerable segment of the market is betting on a price decline, likely due to those concerns around debt, the lack of GAAP profitability, and that big execution risk factor.
And the technical performance hasn't helped the bulls either, has it?
No, it's been weak. The stock is trading significantly below its 50-day moving average, that's in the $4.82 to $5 range, and also below its 200-day moving average, which is up in the $5.57 to $5.83 range.
Both generally seen as bearish signals by technical analysts.
Right, so this really highlights the market's internal conflict. It's a real high volatility battleground. You've got the qualitative bullish story, the transformative M&A, new market leadership, clear path to scale, experienced management, clashing with the quantitative bearish reality, negative GAAP earnings, high financial leverage, negative price momentum.
So that high short interest acts like a coiled spring?
Exactly. If the company delivers, those shorts could be forced to cover, triggering a rapid upward move as short squeeze. But any stumbles, any missed targets will just validate the bears, potentially leading to further declines. Very polarized.
Okay, let's unpack Chapter 5, Ownership Structure. Who actually owns this company?
This is quite interesting, too.
PowerFleet stock has exceptionally high institutional ownership. We're talking professional investment firms holding somewhere between 78% and maybe even over 91% of the outstanding shares.
That's very high.
It is. And this includes highly reputable firms like Disciplined Growth Investors, BlackRock, Vanguard Group. Recent institutional activity actually shows a net accumulation of shares. About 120 institutions increased their positions versus only 71 decreasing them.
So the big money is, on balance, buying in.
Seems so. And notably, Centerbrook Partners LP increased its stake by over 683%, a massive increase.
Wow. What about insiders, management, board members?
Well, insiders and individual investors hold a much smaller portion, maybe around 7.3%. There has been net positive activity over the past 12 months. However, it's important to note that the largest recent acquisitions by top executives, including CEO Steve Towe, were non-open market transactions.
Ah, likely stock grants.
Almost certainly. Equity compensation grants tied to the mergers, designed for that incentive alignment we discussed earlier. There haven't been any significant open market buys by insiders in the last 3 months.
Got it.
And ownership is also significantly concentrated. The 10 largest institutional shareholders control roughly one-third of the entire company.
So their decisions can have a big impact.
Definitely an outsized impact.
So if we connect this ownership structure to the bigger picture, what does it suggest? To me, it suggests PowerFleet is being operated more like a private equity-backed roll-up strategy than a typical public company.
How so?
Well, you have the board and management executing this aggressive, high-leverage growth strategy, but it's supported by patient institutional capital that has clearly bought into this multi-year transformation story. This essentially gives management the air cover, perhaps, to focus on that long-term strategic end state, maybe over a 3 to 5 year horizon, rather than just scrambling to meet quarterly earnings expectations every 90 days.
That makes sense. Gives them breathing room for the integration. Okay, moving into Chapter 6. Risk assessment. This is absolutely critical for you, the listener, to understand the potential pitfalls, the full spectrum of what could go wrong.
Absolutely. Let's break it down. A SWOT analysis might be helpful here. Strengths, weaknesses, opportunities, threats.
Good idea.
Well-
Okay, starting with strengths. We've talked about the differentiated device-agnostic Unity platform. There's the global scale and leadership, top 3 player, 2.8 million subscribers, an experienced and aligned management team, and that diversified blue-chip customer base.
Solid foundation. Now, weaknesses.
High financial leverage is number 1, about $230 million in net debt. Then there's the extreme integration complexity. Trying to merge 2 simultaneous global acquisitions is challenging.
Understatement.
Yeah. And of course, the current unprofitability and negative free cash flow.
Okay. What about opportunities?
Significant cross-sell and upsell potential into those newly acquired customer bases from Mix and Fleet Complete. There's the strong secular market growth in telematics and AIoT that we discussed, and huge future potential for data monetization from their aggregated 2.8 million connected assets. That's a big one down the road.
Right, leveraging that data. Now, the threats, these often get split into external, macroeconomic, and geopolitical.
Okay, let's do that. First, external threats. Intense and evolving competition, both from agile tech firms and those large OEMs pushing their own solutions. Significant cybersecurity risks. They run a connected vehicle platform. That's a huge target.
Critical risk.
And supply chain vulnerability for their hardware business, especially around semiconductors. Still an issue.
Okay, what about macroeconomic threats?
Well, we talked about inflation driving demand for their efficiency products, which is good, but it also directly increases PowerFleet's cost for hardware, labor, fuel, putting pressure on their margins.
Right, double-edged sword.
And rising interest rates directly increase the cost of servicing their substantial variable rate debt. That's a direct hit to the bottom line.
Yeah, leverage cuts both ways.
Yeah.
And finally, geopolitical threats.
This is becoming more prominent. The aggressive revival of U.S. tariffs on Chinese imports is a direct threat. It could potentially increase their hardware cost of goods sold by 25–50%.
Ouch. That would seriously compress gross margins on hardware.
Exactly. And regional instability, particularly in Israel, where they have a key R&D hub, and also in South Africa, poses risks to operations and potentially supply chains too.
So, taking all those risks together, this brings us to what I think is the primary risk. It's basically a failure to launch scenario.
Explain that.
Well, the company has substantial debt that requires significant cash servicing. At the exact same time, you have these potential geopolitical tariffs threatening to increase costs and reduce the cash they get from hardware sales. And on top of that, rising interest rates increase the burden of the debt itself.
A potential squeeze.
It's exactly. PowerFleet is essentially in a race. They need to realize those integration synergies and generate new high-margin SaaS revenue faster than these headwinds can erode their financial position.
Right.
If that integration proves slower or more costly than they anticipate, or if those tariffs are more punitive than expected, they could genuinely face a liquidity squeeze. And that might force them to curtail crucial growth investments. That is the core of the bear case against the company right there.
Okay. That lays out the risks very clearly. So finally, we arrive at Chapter 7, conclusion. Let's synthesize everything we've discussed.
Let's bring it all together.
Okay, the bull case. It really centers on PowerFleet's bold transformation into a global market leader with dominant scale. You've got powerful secular tailwinds in telematics and AIoT pushing them forward. They have that differentiated and sticky Unity platform. There's a clear path to profitability through the high-margin recurring revenue model and those identified synergies. And you have experienced well-backed leadership driving it.
But the bear case provides a very strong counterargument. It's grounded, as we just discussed, in that massive execution risk of simultaneously integrating two complex global organizations. There's a high financial leverage, the current gap on profitability, significant external headwinds like tariffs and geopolitical instability, and those negative market indicators like the high short interest. It's a compelling list of worries.
And our educational discounted cash flow model, just to reiterate, based on assumptions of, say, 20% revenue growth tapering over 5 years and adjusted EBITDA margins expanding towards 28% as synergies hopefully get realized. That model yielded an estimated intrinsic value range of $7.50 to $11 per share.
Right. And as of today, July 16th, 2025, PowerFleet share price of 4.165 cents, well, it trades at a significant discount to the consensus analyst price target around $10.50. And it also falls well below the estimated intrinsic value range from our own model.
So that valuation gap, that difference.
That gap fundamentally reflects the market's pricing of the substantial execution risk inherent in this company's very ambitious transformation. The market sees the potential, but it's demanding a discount for the uncertainty.
So an investment in PowerFleet today is truly, as we said at the start, a high-risk, high-reward proposition.
Absolutely. The outcome hinges entirely on management's ability to navigate this incredibly complex integration process, deliver on those promised synergies, and successfully convert its newfound market scale into sustainable, growing free cash flow.
And they have to do all of that while managing a heavy debt load and navigating these significant external headwinds from tariffs and geopolitical uncertainty. It's a tall order.
It really is.
So what does this all mean for you, the listener?
Well, the current share price, that 4.165 cents, it does offer a considerable margin of safety if, and it's a big if the bull case plays out as management envisions.
However, the potential for further downside remains very real if the company falters in its execution and those bearish risks we outlined actually materialize. This is definitely a story where closely watching the integration progress, the synergy capture, and crucially, the cash flow generation will be absolutely key to understanding which path PowerFleet ultimately takes.
Execution is everything here.
It really is. Okay, if you found this deep dive valuable, remember to like and subscribe to Stock Analytics AI. Our $4.99 a month members get priority deep dives on tickers. And over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access to those.
And if you just want a one-off deep dive on a specific ticker, you can drop us a super thanks.
Yep.
And always remember, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.